If you've ever said, I wish I could buy that house and keep their 3% rate, you're thinking like a golfer who finally learned course management. Assumable mortgages can do that, but they come with one brutal reality. You still have to cover the seller's gap, and the servicer still has to approve the assumption. Today, I'm going to show you the playbook for VA, FHA, and USDA assumptions, and the 3 things that kill these deals so that you can stop chasing hype and start chasing math. So, an assumable mortgage means that you take over the seller's existing loan balance, interest rate, and remaining term. It's not a refinance and it's not a rate transfer. It's a loan transfer that the servicer processes and the buyer still has to qualify for. Golf translation, you're not buying a new club, you're taking somebody else's club and trying to swing it the right way. Every single assumption is going to have the same 3 parts. Number 1, the rate that you want, and that's the shiny thing that you're after. Number 2 is your servicer approval. They're the gatekeepers in the situation. And number 3 is the equity gap, which is the money that you have to bring to the table. If you only understand the rate, you're going to chunk the shop. Quick note, in my current capacity as an independent mortgage broker, I cannot process the assumption itself because the servicer controls that lane. However, I can always be your second set of eyes, help you run the math, check the equity gap, and see the side-by-side comparison to show you if it's actually worth chasing. If you want that sanity check, call or text me. VA assumptions are a core feature of VA loans, but they're not automatic. VA guidance requires approval if the loan is current, the buyer is legally obligated to purchase and assume full liability, and the buyer is creditworthy to meet the VA standards. Now, the timeline reality, because assumptions can feel very slow. If the holder or servicer has automatic authority, they're required to process and decide within 45 calendar days of receiving a completed application. However, if they do not have automatic authority, the assumption package goes to the VA for prior approval, and the VA has a 35-day processing standard for that piece. Now let's talk about the fees, because this is where people tend to get surprised. VA allows an assumption processing fee capped at $300 for automatic authority or $250 for prior approval. And there's also a VA assumption funding fee of 0.5% of the loan balance, which is collected in cash at the closing table, and it may not be financed into the loan. Now, the VA concept everybody seems to forget: entitlement. VA assumptions can happen with or without the substitution of entitlement. If there's no substitution, the seller's VA entitlement will stay tied up in that property until the loan is paid off in full. If there is a substitution, an eligible veteran can buy and potentially swap in their entitlement to free up the seller's entitlement from the property. Entitlement is kind of like a tee time reservation. If you don't free it up, you can't book the next round. And just one more time, I am not the one approving assumptions. The servicer is. My job is to help you avoid chasing a great rate that is actually a bad deal once the gap and the fees show up. FHA loans are also assumable. HUD, or Housing and Urban Development guidance, says that all FHA insured mortgages are assumable, but the FHA added restrictions on loans originated since 1986, and depending on the date, a credit worthiness review by the lender may be required. HUD also notes that mortgages before December 1st of 1986 generally had no restrictions, and for loans closed on or after December 15th, 1989, FHA requires credit qualification for borrowers who want to assume FHA loans. So what does this mean for you? Even if the loan's assumable, you still have to qualify with the lender or servicer processing the assumption, and that's often where the pace of play tends to slow down. USDA guaranteed loans can also be transferred and assumed, but they come with their own set of specific conditions. The USDA guidance says servicers typically must obtain agency approval before consenting to a transfer with assumption of outstanding debts. For certain transfers under Garn St. Germain, USDA notes that the agency may approve a transfer with an assumption if conditions are met, like the transferee assumes the entire outstanding debt and is eligible, the property meets the requirements or is brought to standard, the lien priority is maintained, and the file is manually underwritten. And that manual underwriting point matters because USDA notes that GUS is not available for transfer and assumption underwriting. So the request is manually submitted and reviewed. The USDA also notates that the transferee may assume on the existing rate and terms in the promissory note or potentially under new terms or rates, if eligible, within the program's constraints. USDA assumptions are like finding an open fairway that nobody's using. It exists, but you need to know the rules and you need to expect a little bit of paper. Now, the big one. The equity gap is the difference between the price that you're paying and the remaining loan balance that you're trying to assume. Here's a simple example to put this into perspective. Let's say you're looking at a home that's priced at $500,000. Well, the loan balance that you're trying to assume is only $420,000 at 3.25%. That means you've got to come up with an $80,000 gap, and that gap is typically handled by cash, a second loan, a gift, or a renegotiating the price. This is why assumptions are not magic, they're math. So here's the caddy question to ask. If you bring $80,000 to get the 3% rate, how does that compare to putting a smaller down on a normal loan at today's rates? Sometimes the assumption wins big, and sometimes it's just an expensive way to feel like you won. If you want, comment the word gap and your rough numbers, price, and loan balance, and I will tell you if it looks like a chip shot or a full carry over the water. If you're staring at an equity gap and you're not sure how to compare it against a regular mortgage option, call or text me. I'll run the side-by-side numbers so you can decide with confidence whether pursuing an assumption is actually a win in your scenario. So, like I said earlier, I don't process these. The servicer does. And not every servicer is fast or organized about processing assumptions. The VA has even issued guidance reminding holders and servicers about their obligations to process assumptions and explaining how VA addresses non-compliance when processing assumptions. This is why assumptions are less mortgage shopping and a lot more project management. And you want to know the real cost before you ever volunteer for the project. So here's the checklist I would run if I was looking to do an assumable mortgage. First, you need to confirm the loan type. Is it VA, FHA, USDA, or something else? And make sure that the specific loan is assumable. Second, you want to estimate the equity gap and decide how you're going to cover it. Third is to get the servicer's assumption package requirements early on in the process. Fourth, if it's a VA loan, understand entitlement substitution and the 45-day processing standard once you complete the application in whole. Fifth, if it's an FHA assumption, confirm the origination era and the credit qualification requirement. And sixth, if it's USDA, expect manual underwriting and agency approval. Save this video because it'll keep you from chasing the wrong deal. So if you're out there thinking about assuming a loan and you want the real answer, call or text me. I cannot process the assumption itself. The servicer owns that lane. But I can be your second set of eyes, run the equity gap math, compare it to a normal loan option, and tell you if it's actually worth pursuing for your unique situation. Because at the end of the day, every loan needs a caddy.